8 minutes till the bell rings. Stocks are still well supported. Let's talk some bonds, though, because joining me, Mr. Collin Martin, Director and Fixed Income Strategist at the Schwab Center for Financial Research. One thing I've learned about you guys, Collin, is you've got cool heads. And it seemed like that was the right approach this week, because when I was asking you if rates were going to blow out on Tuesday, they did the reverse, and now we got back below 4.5. So how do we make sense of this U-turn?
Well, before we take a victory lap, we always think it's important to look at the big picture. I mean, the name of this program here, but we try to not focus too much on the day to day and look at what we think will happen from time to time. And when we look at today's report, it didn't necessarily surprise us, but we would highlight that it is just one report. And if we got a hot report in a month, we'd probably see yields rise a little bit. So I think it's important to set the stage there. But if we look at today's labor market report, we viewed it as a positive because we got gains in payrolls, but at a slower pace than what we've been seeing. I think that's a good thing. We want to see job growth, but not to a level that it's too strong, too tight of a labor market that could spur inflation. You also looked at average hourly earnings. We're under 4% on a year-over-year basis. That monthly number came to just 20 basis points. That also is a good thing. We want to see job growth. We want to see wage growth. But we want to see it moderate, because anything that's too hot, that's what drives inflation. We know that's the number one concern, not just for the Fed, but for people across the country and across the globe. That's the main issue. So I think today was a good step in the right direction to a little bit of a moderation. And we hope to see that trend continue going forward, where we still see job gains, we still see wage gains, but just at less of a hot pace than what we've seen over the past 2 years or so.
Now, how much of this should be celebrated versus how much is kind of unideal? I mean, maybe the spin for the Fed is, okay, wages aren't going up, it's good, we're not going to get that wage spiral, but most people don't like to see the wages go down if inflation's not going down with it.
Yeah, that's a great point, and it's conversations I have with not just clients, but family and friends, because you can't have both, right? If you have a really strong labor market and growing wages, you're likely to see inflation, and unfortunately, for better or for worse, right now inflation's too high, and the Fed likely wants to see some slowdown in the labor market. But again, we don't want to see job losses. We don't want to see declines in wages. We just want to see modest growth, and that's what we're seeing right now. So it is a good thing, but I agree that no one necessarily would voluntarily agree to have no wage gains or very low wage gains.
One thing I want to ask you about is we were talking a lot about the bond swings this week and the economic data. Is the Fed's but winding down of QT? How much of a role does that play? Where should that be injected into our conversation about where rates can go right now?
We're not really talking about it too much.
Okay.
We think it's going to happen behind the scenes. It made a lot of headlines, and frankly, I think a lot of negative headlines when they slowed down the pace. And I think there's this misconception that this represents an easing of policy. I saw a lot of headlines about that. That's just not the case. They're tightening by a lesser amount. I mean, that's just the facts of the matter right there. They're still reinvesting their treasuries. They're still reinvesting their mortgage-backed securities or allowing them to roll up. But when you look at the treasury side of the market, this is not an easy. So we try to ignore that. It doesn't really play a part in our outlook, because we expect it to continue to happen behind the scenes. And I think that's a key point about why they announced it now. And what the pace, it allows them to do it for longer, at least that's what their hope is, so that it doesn't become an issue down the road. It comes down to liquidity. That's really why they're doing it. This doesn't really have an impact on policy. And Powell made that point clear. He said their primary source, their primary tool is the Fed funds rate. And this isn't necessarily a signal that we're expecting an easing sometime soon.
Okay. Hey, Collin, speaking of cool heads, I'm about to lose mine in my closing monologue today as I vamp on the ISM from this week, which just struck me as abysmal. You got 60 seconds to talk me off the ledge.
I'm going to stick with my cool head mentality here. I think you need to look at the big picture here. One thing that I'm looking at is prices paid, because I know that on the surface was a concern. And the minute I saw today's ISM report come out, I said, oh no, here's going to be the concern about stagflation, because we saw the key components drop below 50. We saw prices paid go up. We're not worrying too much for two reasons. First, it's one report, and we try to always not focus on one report, but rather the trend. So that's number one. Number two, if you look specifically at prices paid, if you go back a year and a half, we saw them come down pretty sharply. And it was something that admittedly we were talking about, that why we thought inflation should continue to decline. Well, we never got inflation back to 2%. And if you look at that prices paid level, it's at levels we used to see back in 2016, 17, 18, 19, levels consistent with 2%, but we never got there. So just so the little uptick higher, I don't think means that suddenly inflation is going to reaccelerate. I think it's something to keep an eye on, but the trend is not a perfect trend. It's not a perfect relationship.
Okay. To the point of the number of data points, right? I mean, it really does depend on it not being more, because you get a bunch of these and then the conversation changes. I mean, this is really like, we got to hope they don't continue though, right? Is that fair to say? Like, that would be bad?
Well, are you talking about the ISM?
Yeah, the ISM
indices?
skew, prices paid to new orders and stuff.
You know, Oliver, I think it comes down more to the hard data than the surveys, because I feel like, again, we were paying attention to those ISM surveys, specifically services. You have manufacturing and services. I think services are more important because we're a services economy. But if you look at the actual data, the economy is resilient, right? Even though we saw a slight miss in GDP last week, we saw strong domestic sales. So until we start to see it in the hard data, I'm not going to ignore the ISM indices, but I'm going to weigh them less than what I'm seeing in the actual hard data releases.
Understood. And a sound argument, right? Until jobs really break. All right. Appreciate it, Collin. Thank you very much. Have a great weekend.
You too.